We have a big week for interest rate risk coming up. Both a Treasury refunding announcement Wednesday morning and the Fed Wednesday afternoon. Tuesday night, I believe it's the Bank of Japan. And last week we had Bank of Canada on hold. Also ECB on hold. I think the Fed next week will be on hold, and I don't expect anything from Bank of Japan. Let's have a look at our rates last week. Money market rates, all well behaved, very tight range, 1 or 2 basis points per week across all the tenors. Capital market, we had a bit of a reverse of the steepening we've had over the last little while, a bit of a flattening here. But again, we've got a big risk week coming up this week. The calm before the storm, maybe. As far as inversion, the 2 to the 10s, pretty much unchanged week over week. The 3-month to the 10-year is now negative 75 from negative 65. Canada still quite deep on both the capital market inversion and the money market to capital market inversion. Last week, Bank of Canada did nothing, but in the statement, in the last paragraph, reserved the right to increase at future meetings. They pretty much have to say that. If they want to keep monetary policy tight at a certain level for a period of time, they can't signal that they're done. They have to put that statement in, we reserve the right to increase rates. Well, I mean, of course they do, right? I mean, of course they do. It doesn't have to be said. Because it is being said, I think there's a reason for it. SOMA, the Fed balance sheet for quantitative tightening, ran off another $18.5 billion. That account is down to $7.265 trillion. The full balance sheet sitting at $7.9 trillion. $25 billion runoff in the balance sheet, 18.5 attributable to the SOMA, which means the Fed balance sheet had another, on top of the 18,472, another 6.9 billion of runoff. The other segment of the market that has balance sheet runoff right now are retirees, and it is the largest segment, or not the largest segment, but the largest cohort that there has ever been in the retiree cohort. And typically, I'll draw a timeline here, and here is 65. Here's about 25 to 65. As you start working, you start building your assets. They build slow till about your mid-30s, and then they really increase all the way up to 65. That's called the accumulation phase. And then you are in the distribution phase where your assets run down until, well, hopefully they'll outlive you, but your assets run down. So it's not necessarily that this cohort is selling their treasuries or their bonds. They're just not reinvesting. They basically have balance sheet runoff as well, that if they had structured their portfolios correctly, they would have had on the fixed income side a laddered strategy, which means every couple of years you'd have a bond that's maturing. Well, these are not being rolled over, much like this is not being rolled over as well. So you have this very large cohort here that is also engaged in balance sheet runoff as well. Money market funds increased another $25 billion. We had a big decrease last week. Well, that's reversed. Retail up $8.5 billion, both government and prime, and institutional up $16 billion. Government up $20 billion, and prime down $4.4 billion. I expect that this week is going to be, and here's the thing, I don't know what to expect this week, but it's a big week in risk for interest rates. In 3 days, the FOMC at 2 p.m., and then the press conference at 2:30, which seems to be the more important one. Odds are still 0, with just probably a mathematical error here, suggesting a cut. But all the weight on it is 0. I think that's right. I think basically it is 100% probability going forward of no rate hikes. Going out to December, no rate hikes, 80% probability there. Still some 20% sitting on one rate hike. Treasury refunding, I think we get this at 9 a.m. 8:30 or 9 a.m. We get it in the morning. It could even be 11. I'm not quite sure the time. I should have just looked it up, but here I am in the middle of narration. With a missing piece of information. There's a piece of the puzzle you can fill in. That is in 3 days. We get this first, and then we get the FOMC. I think this is going to have a much bigger effect on the longer end of the curve. Jobs data both in Canada and the U.S. in 5 days. For Canada, Bank of Canada Governor Meldrum. 3:30 speech in 1 day, and in 3 days from now at 4:15 speaking again. Canada GDP, we get September preliminary in 2 days. For the US, the ECI, this is the Employment Cost Index, the true measure of wage inflation. We get that in 2 days. JOLTS in 3 days. ADP in 3 days. Initial claims in 4 days. And jobs data in 5 days. Big week for jobs data. Big week in earnings, and with the Treasury refunding announcement and the FOMC, big week for interest rate risk. I think the only safe place you can hide if you're afraid of all of that stuff is cash. New York Fed, effective federal funds rate 5.33%. Going into Thursday, I don't expect that to be any different. Reverse repo, look at this, down another 47 billion, 1.09 trillion. Lots of T-bill issuance, so you don't need that reverse repo. Money has a place that it can hide, and with volatility really super low in the money market, especially government money market rates right now, it's a nice place to be. The 12-month lag, the effective federal funds rate now 5.33. 12 months ago it was 3.08. So if we think there's a lag, the average lag being 12 months, still 2.25 basis points to be felt. And there might be something to the lags. Everything seemed to be fine till about August. Even in real estate, even in this area where I am, because I have my house listed, everything seemed to be fine, but then August it seemed to fall off a cliff. I have the report of all the houses that sold in my area for 2023. And you could see that most of them sold for their asking price till about August. And then the price cuts really started to happen. There was one, I'm on a crescent, which looks like this. There's the road into the crescent. I'm right here. There's one on the other side of the crescent. Was 1.8. They dropped it to 1.5. They have now dropped it to 1.35. That is a huge drop, 450,000. You're talking 25% cut in the price of the house. They dropped it again. Now, difference between them and me, I don't have to sell. I can hold this for as long as I want to hold it. If it sells, it sells. If it doesn't, I'm just going to hold it. They have to sell. Look at that, 1.35 from 1.8. And it wasn't, I think it was only about 3 weeks ago that they dropped it from 1.8 to 1.5 and now to 1.35. So they are getting desperate to move that house. But even the trades, because I have somebody who was upgrading my bathrooms and kitchen, and I was talking to them, and they said just, everything sort of just fell off, that they haven't seen a year where it slowed down this much, this fast. So it could be that interest rates are having an effect, and they've, the cumulative effect of it sort of just hit a tipping point in August and things started to roll over. Real rates holding pretty close week over week, very little movement there, but again, could be the calm before the storm. Fed funds futures, hardly any movement there for December, no movement week over week. For mid-year, for June, 0.5 basis point, and for September, you have 3 basis points, a 3 basis point increase in the Fed fund futures. So we're still fairly consistent here with Q2 showing a 25 or at least one rate cut in Q2, as we see here, going from the end of February to the end of June, then from the end of June to the end of September. Looks like we have another cut there. And when we look at December 24 over December 23, it's 86 basis points, which seems to imply another rate cut in Q4. Over the week, TLT managed some recovery, up 1.36%, SPY down 2.53%, which is kind of a bad signal. closing below its 200-day moving average, breaking its uptrend, the uptrend support line. And even with the good data last week, it couldn't stage a rally. With GDP showing 4.9, with a strong consumer, it couldn't hold a rally. And usually when you start seeing that sort of thing, that prices dropping on good news, usually doesn't bode well going forward. Down 2.53. I made no changes on my position. I'm waiting for significantly higher yields on the 20 to 25 year range. And I'll move more of my TLT into there. I got to do it by the end of the year, but I'm kind of hoping for bigger losses on TLT, so I can offset some of the capital gains I have this year. And yes, I do have capital gains going into the end of the year. I will owe taxes to the Canadian government for that, even with beta and duration beating the crap out of me. My micro bets for the course of the year worked out very well. Implied volatility dropping on TLT, 13-week down to 83% from 95. Mortgage rates continuing to climb, 7.79, up another 16 basis points. Week over week, the 10-year Treasury dropped 12 basis points. The 30-year fixed rate mortgage increased 6. The spread, big increase in the spread, 28 basis points, 293. I think the highest spread was 311, so sitting 18 basis points below a new high spread. Look at agency. Man, they did not have a good week, down 14.63%. September 30th, tangible book value per share, 808. They pre-announced last week for the end of the quarter, which we'll get the results this week. But as of September 30th, their tangible book value per share was 808, and that was the spread widening. Not interest rates, but the spread. They're levered the spread. They hedge out interest rate risk and lever up the spread. And that hurt them. Annaly trading down in sympathy. Arbor down 10%, which is, they had good results. Dividend payout ratio 78%, 43-cent dividend. Net income 77.9 million versus 62.7 year over year. Look at that increase in the same quarter year over year. 41 cents a share versus 36 cents a share. This is GAAP earnings. The dividend payout ratio here is based on funds from operations. So based on FFO, 78% dividend payout ratio on funds from operations. And when they announced on Friday, up they went, and then down they went throughout the day. But week over week, down 10%. They weren't down that much on Friday. I think they were only down 20 cents, 22 cents on Friday. So it was Monday through Thursday that really did the damage, and I think they were trading in sympathy with the other two, or with their sector. And Friday, I think, might have saved them a little bit, but I was surprised to see it all fade away. But then again, ABR doesn't get a lot of respect. They have performed and performed and performed for years and years and years. They perform, but for some reason they just don't get the respect they deserve. It doesn't matter to me. You've got a nice dividend, $1.72 a year. You're getting paid to hold this one. I'll continue to hold it. Home builders had some good news this week. We had new home sales up 12.3% for September, which sort of goes against the decline in home builder sentiment we saw. That if home sales were up 12.3%, you would have think the home builders were a little bit more positive, saying, well, this is pretty good. Look what we're seeing here. But their sentiment just dropped. The home builder index is in contraction all the way down to 40 from 55. So this seems odd, unless they really lowered prices to clear out inventory because they were so negative. Maybe they thought, let's just get rid of this stuff, take any offer that comes in. Maybe that's why we saw this 12.3. Let's see what we see for October. Pending home sales for September down 11%. Mortgage apps October 20th down 1%. Tuesday we're going to get the HPI and Case-Shiller home price index and the Case-Shiller price index. XHB is down, ITB down, not much, but down. This is what we should be seeing with IYR down another 1.51, under 75 bucks now. PLD, look at that, down 5%. But DLR, Digital Realty, up 6%. They had earnings $2.33 a share versus 75 cents a share in the same quarter last year. Triple on EPS. FFO flat though. FFO flat. Revenues up 18% year over year. Their renewal leases are rolling over at an increase of 7.4%. This is data warehouses. I shouldn't say data warehouses. Data centers. There we go. Data centers. TLT, as I said, up 1.36. SPX down 2.53. This is interesting over here on the OAS. Look at, this is IG here, the 3. IG on as a whole, as a group, 1 basis point. That should be red. I don't know why Excel didn't turn these red. The formula isn't working there. But down 1 basis point. So the spread shrunk a little bit here. AA, it shrunk, and BBB held its own. Not much to see on investment grade. But look what happened in high yield, 4.37 to 4.5, an increase of 13 basis points, increase of 8 basis points on BB, and 35 on CCC. CCC now over 10% on the spread. But the spread increased 2.97, 2.68, 3.53, but either contracted or did nothing on investment grade. So maybe we're seeing a separation in interest between investment grade and high yield. Okay, GDP and PCE. GDP came in strong, 4.9%. And this is the contribution to GDP. Here's how we get the 4.9. You simply just add C plus I plus G plus X minus M, the 269,147.79, and the negative 0.08 to get the 4.9. 269 of the 4.9, 2.69 was the consumer. Goods 1.08, services 1.62, and even in goods, durables 0.6, non-durables 0.8, interest rate sensitive. Durables was the bigger one within goods. For investment, fixed investment 0.15, all from residential, and change in inventories 1.32. We don't have the data for the inventories. You get that on the second look. Same with GNI, gross national income. You get that on the second look. This is the first look at GDP. But this would indicate, since it's gross domestic product, all things that were built within the quarter or manufactured or produced within the quarter. So that means that you would have had, this would, on the face of it, suggest a build in inventories in Q3. Government 0.79, both the federal and the state and local contributing positively, and at the federal level, both defense and non-defense contributing positively. For the trade balance, negative 0.08 took away from GDP. Exports 0.68, imports negative 0.75. And for exports, goods contributed 0.54, services 0.14. Imports, goods took away 0.63, services took away 0.12. Moving to PCE, core PCE year over year for September came in as forecasted. The price index year over year, this is headline, 3.4 came in as expected. The PCE month over month, 0.3 to 0.3 came in as expected. Headline came in a little bit hotter, but it's the core that's the more important. Came in a little bit hotter. Personal incomes, this is unsustainable here. Personal incomes, 0.3. The forecast was 0.4, so it is lower. 0.3 came in below the forecast. But look at spending. The forecast was for 0.5, came in at 0.7. And this is for September. September would have fallen into Q3. So you have consumers who really want to spend, but the income is not really showing up. If we look at time series here, May, June, July, August, September, Here are the price indexes: PCE 0.1, 0.2, 0.2, 0.4, 0.4, going in the wrong direction from May to September, right? 0.1, 2 months of 0.2, then a step jump up to 0.4. The core is the more important one here: 0.3, 0.2, 0.2, 0.1. So it was stepping down, but then had a big jump up here, 0.3. This is the percentage change from month 1 year ago. So year over year, PCE headline 4 to 3.2, 3.4, 3.4, 3.4, kind of flat on headline. If we look at core, core tells an interesting story year over year: 4.7 down to 4.3, 4.3 down to 3.8, 3.8 down to 3.7. So year over year, it's coming down, but the month over month has something to say about that. So we're getting some wear down on base effects here, but new base effects being introduced into the series at September. All right, GM and Ford. Ugly, ugly, ugly. GM is now at over a 3-year low. You got to go back 3 years and 1 quarter to get to the low price, down to 27.22. For Ford, you've got to go all the way back to January 11th, 2021, 2 years, 9 months ago, to get to a low that was at 983. So they're both near 3-year lows. Both of them, UAW problems, right? Both of them pulled forward guidance. Both of them noting weak EV demand. Both of them holding off CapEx. For GM, they were expecting in the second half of 2023 to deliver 100,000 EVs, and they said, no, that's not going to happen. And they were expecting in the first half of 2024 to deliver 400,000 EVs, and they said, no, we're pulling this and we're pulling this. That's just not going to happen anymore. GM and Honda were engaged in a co-development project to develop a sub 30,000 EV. That's done. They're just saying, no, I'm out. Mercedes, talking about the price action in the EV sector, saying this is simply just not sustainable. What's going on here? Toyota CEO came out and said people are finally seeing reality here, because they held off for a long time saying, we don't see it. We don't think that this is the time for this. And this, again, is backing the idea that what we've seen in the EV space were the early adopters. Ford, deeper EV losses going forward. And they pulled their guidance. Cox Automotive EV inventory, second quarter of 2022 were 21,000. Second quarter of 2023, this is just year over year. Second quarter over second quarter, 92,000. And for GM Cruise, some bad news there. They lost their San Francisco permits because of the accident. Actually, it wasn't really their accident, but unfortunately, the car did drag the person. What happened was somebody got hit and got knocked in the way of a cruise vehicle, which then dragged them before they pulled over to the side of the road, dragged the person. So they lost their San Francisco permit. They pulled all their cars in all the cities. I don't know that this is the thing that caused GM to really sell off. I don't know that it was, because Cruise was never really priced in. The promise of Cruise was never there. They had an opportunity early in 2022 to IPO this. The plan was really, I think, the CEO of Cruise at the time felt the plan was to IPO it, and Mary Barra said, no, we're going to keep it. It's worth more to us if we keep it. And she then fired the CEO of Cruise, because the CEO of Cruise was adamantly opposed to that, saying, no, IPO is the way to go. I think they lost their window. Had they IPO'd at that time when there was a lot of hype and excitement around robo-taxis and autonomous vehicles, they could have gotten probably a $50 billion valuation just from that IPO, and they lost it. The company's market cap now is way below 50 billion, and Cruise probably has minimal value. But to be honest, it really wasn't priced in to begin with. I think the big issues here with GM and Ford are the losses that they're seeing on their EVs, the lowered guidance on delivering the EVs that they said that they would, and UAW making gains and demanding that any EV lines or any battery lines be union. You can't compete with all of the foreign companies that aren't union. Simply can't do it. This is really a North American problem, and I don't see myself wanting to be in GM or Ford anymore. So they are off my watch list. I find no excitement in these, and I think they both have more downside to them. But when they were getting involved with the UAW negotiations back here, I said normally I sell puts every time they've dropped down. I've sold puts and they rallied, and they drop down. I sell puts and they rally. They drop down, and this time I said I'm not selling any puts on this one until I see what the result of this thing was, and I didn't do anything. I resisted every time little bits of news came out that maybe they're close, maybe this, maybe that. I said nope, because if whatever they get this time, if GM and Ford go on to be successful in 3 years, they'll be back with their knives out, holding it to management's throat again, saying, give us more or we'll slit your throats. Every 3 years they'll be back. I thought that being that they pretty much destroyed the car companies in 2007, 2008, that they would recognize that too much union success means you're going to lose your job faster because you're going to destroy the very company that you're feeding off of. Unions are parasitic, and they do destroy their hosts. I would not touch GM, and I would not touch Ford at this point. Let's look at SPY. Also not a very good story. The 200-day moving average is 423.04. The 50-day is not on here, but it looks like this. The 50-day is rolling over. 50-day is sitting at about 435.16. So we are now on crosswatch. Crosswatch is if this continues on the 200-day, because the 200-day will still have a lot of weight back here. We'll probably still head up for a little while the 50 moves down, because the 50 is, the last 50 days you've got weight over here. When the 50 crosses below the 200, that's called a death cross. So we are now on crosswatch. 35 to 23, they are $12 apart. Forward 4-quarter operating earnings, 238.46 from IBES, 235.71 SP Global. Take the average of the two. The closing price was 41.1737. The forward multiple is down to 17.36. I put a 15 and a 16 in here. The 15, 35.56. The 16, roughly about 3,800. There is only resistance now. The next line of support would probably be somewhere around 38.50, and then maybe down to 3,800. Or you could say, well, we might get some support here down around 405 to 400. You can draw lines on this chart and on any index level chart, till the cows come home. You can draw whatever line you want to see in the chart. If you want to see a bullish pattern, you can draw lines to make a bullish pattern. So I'm not into the whole RSIs, MACDs, Fibonacci's, all that nonsense. Come on. Draw a few support and resistance lines, the 200-day, the 50-day, uptrends, downtrends. You're good. You're good on that. Could that be a possibility? 37.93. Based on the technical action last week and the price action on the fundamentals. Overall, it was pretty good earnings. We'll have a look at how earnings went and the percentages by which earnings and revenues are beating estimates. And GDP, given all of that, this market could not stage a rally last week and continued to sell off. That 16 may be a possibility. The 238.46 is down from 238.95. not much, but it is down. The 235.71 is down from 236.43. And implied volatility still elevated, 100% 13-week, 100% 26-week, and 69% on 52, up from 67. All right, let's go through a few charts here. During the week of October 30th, the week coming up, 164 companies expected to report. 164 for earnings. Treasury refunding, Bank of Japan, the Fed, jobs report on Friday. Big risk week this week. Look at this earnings revision straight up here. It had turned down, but over the last week, up we went. We look at the earnings scorecard, earnings versus expectations, beating by 7.9%. This is expectations. This is not like quarter over quarter, year over year. It's a here's what everybody expected, and it came in 7.9% above expected for 245 that we're reporting. It says here 500, but that's wrong. I think it's like 504 now, 504 of them. Looking at revenues, revenue 1% higher. That's, I mean, if we're going to find trouble somewhere, that's probably where we would be. This is the expectation. That's only coming in 1% higher. This is coming in 7.9% higher. So you can, there's a lot of work you can do below the top line in both accounting and just efficiency gains to get that. But efficiency gains tap out at a certain point. You can't continually get those. They're you know, a couple of quarters and then you're done on that, unless the revenues are really showing up. Now we don't know what the revenue level is. It's just that it's 1% above the expectation. So if we're going to find fault, you could probably find it here. And I think they got a typo here. 245 reported 244. Are they saying one company didn't report their revenues but reported their earnings? I think they got a typo here. That's lazy work, guys. Who are these guys? Tajinder Dhillon. Hey, dude, you got some sloppy work here. 245, 244. Come on, people are depending on you. Let's see. This is earnings growth rates. A growth rate 4.3%, growth of 19.9 billion. So we can see that you have this is for earnings. This is third quarter of 22, third quarter of 23. Earnings are up 4.3%. Let's see where revenues are. That's Q4. Here is revenues only up 1.4. That, you know, if you're going to find fault, there's where you would find it, up 1.4. And if you look at what nominal GDP was over that period of time, it was significantly higher. 1.4 is below the level of inflation, which means the real revenue is negative, right? If your nominal revenues are have grown over the year 1.4%, and CPI is coming in at let's say even 3.5%. Let's be really generous and say it came in at 3%. You'd expect revenues to be 3% higher if price levels are 3% higher, because, well, you have 500 companies. That's a big, broad spectrum of the market to only be up 1.4. You have to conclude that real revenues are negative. So if you're going to find fault, there's where you would find fault. Let's go down and have a look at who's reporting this week. There's a lot. Now here's the thing. Again, this week, the spreadsheet from SP Global and this document do not line up in terms of who's reporting on what date and how many companies are reporting. I've never seen that. They've always sort of been, you know, the same thing. But here, they're so wildly different. I don't know what's going on. I don't know who the lazy one is. And I wasn't going to fact check each and every single one of these things to see who was right and who was wrong. Anyways, there's a broad group of companies from all the sectors reporting this week, but the link is in the description box. There's Monday, which you can see some before the bell, some after the bell. When we get into Tuesday, it picks up. Here is Wednesday. Wednesday's a big day, falls over onto 2 pages. A lot going on Wednesday, and then again on Thursday. So not only do you have the Fed on Tuesday. The Treasury refunding on Wednesday. The Fed on Wednesday. You have the biggest group of earnings on Wednesday as well. So that's going to be a wild ride. Which way is the market going to get pulled on that one? There is Thursday, which is another big day, and then Friday you don't have very much, but Friday is jobs day. And that is the week.